I think that the gold rise is inevitable. US dollar quoted price of gold at least doubles and probably increases threefold. I sold about 80% of my physical silver, and I deployed half the money in silver stocks in a basket of 7 silver stocks. I think if the silver price rises, it'll be good for the silver stocks. From a speculator's point of view, I personally would prefer to be in silver stock market rather than the silver market. The war has caused people around the world to be nervous. Despite the evident weakness of the US government, the world's preeminent reserve currency is the US dollar. Perversely, the war has made the US dollar more attractive. Foreign central banks still instinctively goes for the US dollar. The war has forced up US long-term interest rates. And the higher interest rates in the US relative to other currencies has brought more money into the dollar. Gold is denominated in dollars. A more expensive dollar yields weaker gold. I suspect that gold will weather the storm better than currency investments. Almost no matter what we do globally, with the exception of a depression, the copper price has to rise because we're going to use more copper than we produce. You're going to have to ration it by price.
You've been consistent with that message over time. For gold, I've got one more question on gold, which is where would you place us in the cycle right now? I'm also seeing a lot of questions after the big run up at the beginning of the year. We pulled back and people are wondering what happens next. So how would you see that in terms of the cycle?
I've been asked repeatedly to quantify the gold bull market as a baseball game and talk about what inning we're at. I'm not really a baseball fan, but I'm going to guess we're in the 6th inning. I believe that the gold bull market began in the year 2000. Many people feel differently, but in the year 2000, gold was at $253 an ounce. So gold has risen approximately 20-fold in 26 years. I think the gold bull market has at least 10 years left to run. If we've had a 25-year bull market and it has 10 years left to run, it makes some sense that we're in the 6th inning or the 7th inning. I don't think, well, let's look backwards. In the year 2000 to 2026, gold priced in US dollars has risen at about 9% compounded for 26 years. Pretty good performance, by the way. I think that performance likely continues. Specifically, I think if the US dollar loses 75% of its purchasing power over 10 years and gold maintains its purchasing power, it stands to reason that the nominal price of gold, which is, say, the US dollar quoted price of gold, at least doubles and probably increases threefold.
Gold can look expensive right before currency starts looking cheap. Rick Rule notes a 20-fold move since 2000, but the deeper signal is not price momentum. It is purchasing power erosion hiding behind nominal stability. If gold compounds near historical pace while debt expansion stays politically protected, savers in cash absorb the silent loss first. Wall Street debates entry points, while long cycle holders watch currency dilution. Next, Rick Rule reveals why a rising gold chart can still understate the real monetary breakdown.
That's very consistent with the experience that we had in the decade of the 1970s, the last time the US dollar lost 75% of its purchasing power. In truth, in the 1970s, the gold price ran 25-fold. But you must remember that it ran 25-fold from price-controlled levels, given that it's already run 20-fold. I suspect that more modest goals need to be in place for gold. And I'm not suggesting necessarily that people speculate in gold or even invest in gold. I'm suggesting that people do as I've done and save in gold, that they buy gold merely to maintain their purchasing power.
Of course, we have to also take a look at silver, which is another one that we've been talking about in many of the recent past interviews. So if we look back to January, I believe you'd said that the speculative outlook for the silver stocks was better than it was for silver itself. So I want to check in, see if that is still how you're feeling about silver and the silver equities.
Well, with one exception, that thesis has played out well for me. As you know, Charlotte, I sold about 80% of my physical silver, and I deployed half the money in silver stocks in a basket of 7 silver stocks. 6 are up nicely. 1, Vizsla, through no fault of silver, but rather operational difficulties where 10 of their employees were murdered, fell. I believe that thesis to be true to this day. I think if the silver price rises, it'll be good for the silver stocks. If the silver price goes sideways, interestingly, the silver stocks are priced in the market as though silver was at $42 or $45, but it's not.
The safer asset is not always the one investors physically hold. According to Rick Rule, silver equities can outperform even when silver itself stalls, exposing how valuation discounts matter more than headline metal prices. If miners are priced for weaker silver, while sentiment stays cautious, upside can emerge before retail notices. This affects disciplined savers because capital often leaks through poor asset structure, not wrong macro direction. Next, Rick Rule exposes why market pricing can contradict silver's actual strength.
It's at $80. So interestingly, the silver price can go sideways and the silver stocks can still do well as a consequence of their discount. And more perversely, if the silver price falls, there's room in the silver stock valuations, given that they're priced at discount $45 silver. If the silver price falls, I think the silver stocks fall less precipitously than the metals. So from a speculator's point of view, I personally would prefer to be in the silver stock market rather than the silver market. You'll remember, too, from our earlier interview that when I sold that silver, I deployed half the money in the silver stocks. I deployed 25% of the money in oil stocks. As a hate trade, the hate trade's over. People don't hate oil anymore. The wars cause them to, if it's the right phrase, love oil. And I put 25% into savings, about 20% into physical gold, and about 5% in short-term U.S. treasuries. That part hasn't changed. I have been trying of late to increase my liquidity because I'm concerned about the potential impact of the war and interest rates on credit markets. And I'm concerned about the fact that we could have a liquidity squeeze, a confidence squeeze. And in a liquidity squeeze, you need liquidity. I'm done raising liquidity now. I've got all I need personally. I don't know that your viewers have all they need personally, but I have all I need personally. And I'm going to start being speculative again. My own portfolio is very adequately weighted, the very, very high quality companies, the Franco-Nevadas of the world, the Agnico Eagles of the world, the Exxons of the world.
Liquidity usually matters most right before confidence disappears. What Rick Rule is highlighting is that asset allocation shifts often signal stress before headlines admit credit risk is building. Moving toward liquidity while preparing to speculate suggests a timing hedge, not fear. For investors, this is where portfolio survival becomes less about prediction and more about flexibility when markets seize. Next, Rick Rule unravels why holding cash during instability can become an offensive move, not defensive caution.
Where perversely I'm underinvested is the sector I cut my teeth in, which is the sub $250 million market cap explorer or developer. And that's where I'm going to be allocating more of my own capital in the next 90 days, assuming that the opportunities present themselves.
Right. So assuming we do have that liquidity squeeze and it creates an opportunity for you, you're going into those smaller companies. Is there anything else you can say about where you'd be looking in terms of commodity or anything you could mention there?
I need to clarify what you just said. I'm going to be allocating to speculation irrespective of the liquidity squeeze. If a liquidity squeeze happens, I'm going to see what falls most. In other words, I'm going to recalculate everything. If I could get Exxon on a 50 or 60% off sale, or Cameco on a 50 or 60% off sale, I'd be on that print like white on rice. I'd stop speculating. I'd go for the best of the best cheap. Relax. For most of the time that you and I have been interviewing each other, Charlotte, I've preached buy hate. And there's not much hate left in the resource markets. I think the easy money has been made. I think the sure money is in front of us. As an example, I think almost no matter what we do globally, with the exception of a depression, that the copper price has to rise because we're going to use more copper than we produce. You're going to have to ration it by price. If we didn't have a war, the same would be true about the oil price.
Markets call it recovery, but tight supply keeps writing a different script underneath. Rick Rule's argument suggests commodity pricing may be driven less by optimism and more by structural scarcity that policy cannot easily fix. When supply must be rationed by price, cheap assets become strategic, not speculative. Investors ignoring this can underestimate how inflation pressure reaches portfolios through resource shortages before CPI fully reflects it. Next, Rick Rule reveals why scarcity can overpower even broad market confidence.
I think that the gold rise is inevitable, but none of them are hated. The circumstance where you and I talked 6 years ago, and I talked about the fact that all of the social media comment about silver was negative, and so the silver price had to go up. Well, it did. So the hate trade is gone. But the certainty with regards to increased commodity prices as a function of decreasing supply and global demographic growth is very much intact.
While we're talking about the Iran war, I think I have one final point that I want to go over there. You're talking about how it's interestingly, it's resulted in this strength in the US dollar, at least in the near term. But I know over the much longer term, you've talked about how it will lose 75% of its purchasing power. So can you talk about how those elements interact with each other and what timeline you're now looking at for that to happen?
I don't see many things changing in terms of long term. Obviously, I hadn't anticipated war. I had anticipated that if the political class left the interest rate alone, that it would rise. I didn't anticipate that the political class would leave the interest rate alone. It would seem now that the U.S. Fed still has control of the 2-year rate. But the longer rate, it would appear that they don't have control over. The market's beginning to reassert control over the long rate. This will create problems for the U.S. We have almost $40 trillion in debt at the federal level to service.
A stronger dollar can still mask deeper weakness underneath sovereign debt stress. This is where Rick Rule's thesis shifts from commodity cycles toward bond market control and political limits. If long-term rates start escaping policy influence while debt servicing expands, central bank narratives become harder to defend. For savers, this is not abstract macro theory. Higher debt pressure can reshape currency value, rates, and purchasing power. Next, Rick Rule exposes why bond markets may contradict official confidence faster than gold charts do.
And this higher interest rate means that more of the money that we don't have goes to service the debt, and less of it goes to fund the things that we seem to find it necessary to fund, like wars. This is not a good combination. I think it's likely that the voters and the political class will ultimately insist on lower interest rates, which they will have to accomplish mostly by printing money. The only way that they can bring the long rate down is to buy the long bond and increase cash, and you can't buy the long bond with money that you don't have. So you have to create that money. You have to print it. That means that in order for lower interest rates, you have to have quantitative easing. Quantitative easing is what they call counterfeiting when the government does it. And that is very, very, very hard on the purchasing power of the dollar. Creating more false currency units does not enhance the value of the existing false currency units. And artificially low interest rates that are substantially below the rate of deterioration of the dollar is bad for the dollar, but good for gold. And that's the sort of truism that your listeners need to understand. In the near term, the higher interest rates are likely plateauing or causing the gold price to decline. In the intermediate and long term, the political implications of high interest rates likely can't be stomached by societies in as much debt as the United States and Canada. And I think the political class and frankly the voters will insist that we do something stupid and manipulate interest rates down, which is very good for gold.
Higher rates are sold as discipline, but over-leveraged nations often treat them like temporary theater. As Rick Rule points out here, when debt servicing starts consuming capital faster than governments can politically tolerate, pressure builds toward easier money regardless of public rhetoric. The contradiction is simple. Central banks talk stability, while liquidity tools quietly expand when strain deepens. For long-term savers, currency dilution can damage purchasing power far more slowly and silently than market crashes. Next, Rick Rule reveals why rate cuts can strengthen gold even while policymakers claim inflation control.
I think, yes, this is a good pathway over to gold, which of course we also have to talk about. For you, recently, over the past months, there's been a lot of focus on how the Iran war is impacting the gold price. So I've been hearing a lot about that. What do you think is the main driver of gold right now? How important really is the war in the grand scheme of things?
I think it's very important. The war has caused people around the world to be nervous. And despite the evident weakness of the U.S. government, the world's preeminent reserve currency is the U.S. dollar. So perversely, the war has made the U.S. dollar more attractive. In the flight to quality of the private sector, if not foreign central banks, still instinctively goes for the U.S. dollar. In addition, the war has forced up U.S. long-term interest rates. And the higher interest rates in the U.S. relative to other currencies has brought more money into the dollar. Gold is denominated in dollars. A more expensive dollar yields weaker gold. Our mutual friend, Doug Casey, laughingly says the U.S. dollar is the worst currency in the world with the sole exceptions of all of the others. And the last 90 days has certainly proven that to be true. I'm not suspecting, Charlotte, and I think I've been consistent in my interviews with you in saying this, that the U.S. dollar will do poorly compared to other currencies. I think other currencies will do at least equally poorly over the next 10 years. So I'm not suggesting, as an example, a swap out of the U.S. dollar for the Canadian dollar or the euro.
Markets can panic into the very asset they quietly distrust long term. Rick Rule notes that war-driven fear can strengthen the dollar even when structural weakness underneath remains unresolved. That timing matters because safe haven flows often distort price signals, making gold appear weaker while monetary fragility is still building behind the scenes. Investors focused only on headlines may confuse temporary currency demand with real economic strength. Next, Rick Rule exposes why dollar strength during conflict can still hide deeper bullish pressure for gold.
What I'm suggesting is that during periods of time when nominal interest rates in various currencies don't compensate you for the deterioration in the purchasing power of those currencies, gold does well. And I suspect that gold will weather the storm better than currency investments. I'm not suspecting that the purchasing power of gold necessarily goes up. I'm suggesting that it maintains its purchasing power, while your Canadian dollar savings and my US dollar savings over time reduce our purchasing power.
And just going back to the silver stock. So I was going to ask you if you'd made any changes to your silver stock holdings since we talked earlier in the year. It sounds like not. But then I also wanted to, because you're talking about Vizsla Silver and the tragic incident that happened there. There's been a recent development there with Elemental Royalty announcing plans to acquire Vizsla Royalties, which owns the royalty on the Vizsla Silver project. So just want to, that's a little bit specific, but how do you like that transaction? Do you see it helping the company? What are your takeaways there?
I think that deposit is important enough to Mexico that it gets built. I'm not sure that it gets built on the short-term basis, but I think it's the fourth or fifth or sixth best undeveloped silver deposit on the planet. And so I think it gets built. I don't know how it occurs, but I think it gets built. I think the decline in both Vizsla and Vizsla Royalty enabled the Elemental Royalty people and their backers, Tether, to get a superb royalty.
Assets do not need explosive upside to outperform weakening money. According to Rick Rule, gold's advantage may be less about appreciation and more about preserving purchasing power when rates fail to offset currency erosion. That same logic extends to strategic royalty exposure, where distressed pricing can create long-term leverage before development fully matures. Savers often underestimate how quietly value transfers from cash holders to hard asset owners during these slow cycles. Next, Rick Rule unravels why discounted royalty deals can reveal conviction long before broad markets react.
At a price that was at once a substantial premium, 30% plus premium to the then share price, but also likely becomes accretive to the elemental shareholder. In other words, a true win-win. It also diversifies the risk. I was a decent-sized Vizsla royalty shareholder. And in that circumstance, I had all of my investment tied up in the politics of the state of Sinaloa in Mexico, which is occasionally disquieting. Now, I own that interest in a company with over 200 royalties worldwide. So the percentage risk I run as a consequence of social unrest in Sinaloa is much lower. So I'm happy. I was a big shareholder of both. So I'm happy.
Okay. Thank you for sharing on that. And one more follow-up here. So you mentioned Tether's involvement in Elemental and in other places of the royalty space as well. I don't think I've asked you. I've been asking a lot of people their thoughts on this involvement from kind of an outside player coming into the gold space. What are your thoughts on that? Do you like that involvement? How do you feel about it?
I do. I only know one of the Tether people, and I don't know him particularly well, but I'm very impressed so far. I'm impressed about the fact that they've built one of the world's largest financial services businesses from scratch. That's extremely interesting. I'm interested too, talking to them about what they're doing with their own money, because it's important to note that Tether, they're major shareholders. They aren't creating a stable coin out of prospect generators or royalty companies.
Premium pricing can still be defensive if it reduces concentrated geopolitical risk. What Rick Rule is highlighting is that diversification across royalties can matter more than short-term valuation noise when jurisdictional exposure is unstable. Institutions often pay for optionality, not just current yield, especially when unrest can impair a single concentrated asset. Retail investors chasing headline upside often ignore how risk compression itself protects long-term capital. Next, Rick Rule reveals why outside capital entering gold structures may signal institutional patience, not speculation.
They're using the money that they have left over from the interest on their U.S. Treasury holdings and the tiny management fee that they get on their gold to, in effect, buy these stocks with their own money. Which is important. They see the ability in the royalty space. They see the valuation discrepancies between the third-tier royalty companies and their market cap relative to net asset values, and the cost of capital or the valuation discrepancies for the Franco-Nevadas of the world, and they see that the little ones relative to the big ones are cheap. And they have suggested that they will invest in the sector until either the arbitrage goes away, or they will combine the third-tier royalty companies to create a tier one royalty company, or the big guys will acquire the little guys. And I like that way of thinking. I like the fact, too, that the royalty companies, the little ones, at least the well-run ones, have a new champion. And a rational champion, a shareholder who, if they're making a mistake, will say, you are making a mistake, and will likely punish them if they continue to make that mistake. I like, too, the fact that there is the possibility for horizontal amalgamation, which is to say mergers in the small space. That often doesn't happen because in a merger, one management company must lose. And no management company wants to sacrifice their salary to the well-being of their shareholders. Having adult supervision in the space, powerful adult supervision in the space, looking after their interest, and as a consequence of that, looking after the interests of other shareholders, I think is a very good thing. This is committed capital. This is capital that believes that gold royalty is undervalued, that Metalla is undervalued, that Elemental is undervalued. And to the extent that these companies have opportunities to acquire royalties or participate in streams, I suspect that Tether will be lead orders, which will mean that they will have the ability to raise the capital to grow, which hasn't been certain in all markets.
Small royalty firms can stay ignored until larger capital decides mispricing is strategic. Rick Rule's argument suggests smart money is not just buying exposure. It may be targeting valuation gaps, consolidation leverage, and governance influence. That breaks the passive market narrative because committed capital can reshape an entire niche before retail understands why multiples re-rate. For precious metals investors, ownership structure can become just as important as the metal itself.